100% mortgages are back again, and in this video I'm going to be telling you everything you need to know from what the offer actually is, the pros and cons, and who this 100% mortgage might actually be right for.
Okay, let's go.
I think it's actually not going to be useful for that many people, but we'll come on to that later in the video. I'm going to try and keep all of this as succinct as possible. So at a very high level, the absolute basics, you can get a 100% mortgage, which means you need a 0% deposit. The interest rate is 5.49% over a minimum 5-year fix. The max loan you can get is 600k. So they're the key figures you need to be aware of and keep them in your mind as we go through the rest of this video. So for a bit of background, you actually can already and have been able to already get 100% mortgages, but they normally require a guarantor or some sort of financial backing from family or friends.
Oh, friend!
This is different because it doesn't need any of that. You can go and get 100% mortgage without any backing or guarantors using this product. Who is actually offering this product? It's Skipton Building Society. So they're calling this the track record mortgage, and they're the 4th biggest building society in the UK. So given that it's obviously difficult to get onto the house and ladder, this presents another option for people to get onto the house and ladder. But then it raises the question, as we're going to come on to, if it's not actually that useful for that many people, is it just a publicity stunt? Let's talk about the actual conditions then. The key conditions are good credit history, of course, which will be checked, and proof of payment of rent and household bills for consecutively for 12 out of the last 18 months. So in short, you need to have been paying rent and paying household bills and paying them on time for the last year to qualify for this mortgage, or I should say to qualify for this product. They're the key conditions, but there are other conditions, of course, and it might be likely that most people will maybe not meet one or more of these conditions. So you must be 21 or older, you must be a first-time buyer, you still must pass the affordability checks, which is a big thing I'm going to come to shortly. You must be able to pass the credit checks. You cannot have missed any bills or subscriptions or anything for the last 6 months. And number 6, you can't use it for new build flats.
Now that's a lot of damage!
So they are the conditions when it comes to actually being eligible to get this new product, this new 100% mortgage from Skipton Building Society. An important point to make here is that the monthly mortgage repayment will be no more than the average of your last 6 months' rent. So if for the last 6 months you've been paying £1,000 in rent per month, then the maximum mortgage you can get will be £1,000 per month. Now, this is a limiting factor. I'm going to come on to this shortly when we get onto the cons of this new product. But before we come on to pros and cons, let's once again look at the finances. So it's a 0% deposit, 100% mortgage, a 600k maximum loan, and the interest rate is 5.49% over a 5-year fix. And now that is a higher interest rate than other 5-year fixes, of course, because you're getting a 100% mortgage. It's also higher than other loan to values or other mortgages. So if you've got a 95% mortgage or a 95% loan to value, you would save roughly £3,000 in mortgage payments across a year. So of course, because you're getting more money and you have 0 deposit, you're then going to pay more back monthly. So I imagine this will be popular because once again, it's another way to get onto the house and ladder, and particularly down south in England, around London, it can be nearly impossible. So will this product help? We're going to come on to that in a sec, but first of all, let's quickly discuss the pros. And as I already mentioned, number 1 is that it's another option to get people onto the house and ladder. Number 2 is that it's also aimed at people who have paid rent. So I think whereas before, if you look back to 2008 and the subprime mortgage crisis, essentially anyone, dogs and cats, were getting 100% mortgages, more than 100% mortgages. There wasn't really much checks going on. Now, this is clearly aimed at people who have been paying rent and paying it consistently, but they clearly just can't save up that deposit pot to get onto the house and ladder. So hopefully even though there are still cons we're going to get into, it's more of a sensible product. And linking into that, number 3 is that it's still subject to all the affordability and credit referencing checks. So hopefully it shouldn't stitch people up in terms of their financial situation, because you need to meet all these checks and tests and criteria to actually get this product. The cons now, and yeah, there's a few of them, so let's get into them. Number 1, and the biggest one, is negative equity. Now, this is essentially where your mortgage is then higher than your house price, so you are in negative equity. So if the house prices were to drop even by 1%, you would then technically be in negative equity because you have a 100% mortgage and now the value of your house has fell. So yeah, you're in negative equity.
Uh-oh. Spaghetti-O!
Now this is quite a big risk considering the current environment. So obviously interest rates have been increasing very steadily and they probably will continue to increase, and generally returns, whether it's in the housing market, the stock market, are negatively correlated with interest rates. So as interest rates rise, normally this causes asset prices to fall. So if interest rates do keep rising, you would expect house prices to fall. Some people have been speculating house prices are due to fall anyway because there was such a boom during COVID. At the end of the day, no one knows what prices in the property market or the stock market are going to do tomorrow. So ignore predictions, they're pointless. But the point is that with a 100% mortgage, you have no wiggle room. So if there is any adverse falls or negative falls in house prices, you will be in negative equity. This isn't much of a risk if you're going to buy somewhere and live there for the long term, because the chances are house prices steadily go up over time, over the long term, although in the short term, they can obviously fluctuate. It's more of a risk if you're not going to live there long term, then you could get locked into a house that you don't really want to be in, but you can't refinance or sell it on because you're in negative equity. So that's the main risk to be aware of, which is ultimately why I'd say if you can still get a 5 or 10% deposit together, that's probably a better way to go about buying your first home. Another con is actually how much you can borrow. So the amount you can borrow is based on how much rent you're paying. But as you can see by this graphic, if you're paying £1,000 a month in rent, which is what I was paying when I was living in London before, you could only borrow a mortgage of about 163k. Now, if you live in London, you'll be lucky to get a car parking space or a canal boat with that money. So you're not good. You probably can't even build a shed for that much down south. So it's not particularly brilliant unless you're paying crazy rents. So at 5k rent per month, if you're somehow paying £5,000 a month, you can then borrow the maximum 600k. But I would argue if you're paying 5k per rent per month, you probably can just live somewhere else, get a cheaper rent and just save up for a deposit and then go down the normal route. You probably don't need this product. So I think if you look at this graph here, unless you're paying like £1,500, £2,000 per month in rent, which is a lot of rent, then you can get a bigger mortgage. But if you're only paying for yourself £600, £800, £1,000, even £1,250 per month, the mortgage might not be big enough to get a house that you actually want. Which sort of brings me on to a big point of this video, and the main issue really, even with this new product, even though it does give another option, even though it can help some people, which you're going to come on to, the main issue is affordability, and that's just the property market in England in general. You can only borrow around 4.5 times your salary as a mortgage. But the issue is, because there's such now a big disparity between house prices and salaries, 20, 30 years ago, it was 3 to 1. Now it's 10 to 1. So, house prices on average in London are 10 times people's salaries. Because of that disparity, you can't actually borrow enough to get a house that you like. Even on a decent 50k salary, you can only borrow around 225k, which of course won't get you much in many parts of the country. So I think the main issue is still affordability. How to solve that is obviously a huge question in itself. The easiest way to get across this is simply getting a partner and buying with a partner.
You serious?
Then your affordability essentially doubles. You can also have 2 lifetime ISAs, so get more free money from the government and loads of other stuff. I'm not gonna go into it now, but realistically, I think the best way of buying a property right now is getting a partner, whether hopefully it's like a long-term partner you'll be with forever, but get a partner, you can then borrow double the amount, get a house you actually want, and have 2 lifetime ISAs, 2 regular savers, 2 saving pots going into that deposit. So let's talk about who it's actually good for. And I personally think, from just reading up on it, it's good for people who are paying high rent in areas where house prices are cheaper. So maybe people who are paying higher rents in city centres like Leeds or Manchester or Liverpool, where of course properties around the suburbs of those areas are cheaper, that's where it could maybe help. Now, I don't know the Manchester property market very well at all, if at all, but let's just say you're living in the city centre in a very nice flat and you're paying a very high rent of £1,000 a month. I assume that's high for Manchester. You can then borrow 163k roughly. So I'm sure if you go 30-40 minutes out of the city, you might be able to get a pretty decent house for that. So I think that's where it helps. As I sort of mentioned, I don't think this is really going to help many people who are living down south or in and around London unless you're paying very high rent. If you're somehow paying £5 grand a month, you can then borrow 600k, and that of course can get you a house, hopefully somewhere in the suburbs of London. But of course, I would then once again argue, just live somewhere cheaper for a year, reduce your rent, save up for deposit, and just go down the normal route rather than using this product. Oh, I think that covers most things. I'm just gonna quickly have a think and look through anything else we can discuss. One thing I will flash up here at the end again is this graphic just showing the interest rates and how the higher loan to value or the higher mortgage you're gonna get up to 100%, the much higher your yearly cost comes. So even if you can save a 10% deposit, not only is the risk of negative equity is very low because house prices would have to fall 10% for you to get into negative equity, but also your mortgage costs are, £4,000 cheaper a year, which is quite a decent amount, particularly if you're getting a 5-year fix. You're saving £4,000 a year for 5 years, you're saving 20k over that period. Ultimately, to conclude, someone made a very good quote that I saw in a BBC News article, and it said, "If I can prove I've been paying rent for the last 10 years of my life, why can't I have a mortgage?" It's a very good point. And I mean, why you can't have one really is because house prices are ridiculous compared to salaries. We've already gone through the affordability stuff, but it's a very good point. If you show you're sensible and you've never missed a rental payment, you're responsible with your money, then you should be able to get a mortgage. And this is sort of the gap that this product is trying to fill. But as we've already shown previously, the fact is, the amount you can borrow depends on how much rent you're paying. And unless you're paying very high rent, you probably can't borrow enough to actually get a mortgage for a property or house that you want. But in the same vein, as I mentioned, it could help specific people based on your certain situation. So the best thing to do, I would say, is do a bit of reading into this, maybe watch some other videos, Google Skipton 100% mortgages, read some other articles, form your own opinion, and then probably speak to a independent mortgage advisor or broker and see if this product could work for you. I have a feeling it can help some people, although not the majority. But if it does help you get on a property ladder, of course, that's great. But once again, be aware of those cons we spoke about already, negative equity. I'm gonna leave the video there. There's an interesting discussion on this, and there has been on some tweets and Instagram posts I've posted up. So yeah, feel free to contribute to the discussion there. But thank you very much for checking out this episode. And yeah, I'll see you in the next one.